stock is going to continue outperforming because it's the leading indicator. And who's going to follow? Commodity usually follows stocks. And I can tell you guys, the interesting research, it's been working for the past 20 years. Commodity usually lags stocks by 3 months. So let's give you one example. The full recovery of the economy for the past couple of years starts around September 2009. So when did we see the stock bottom? We see that in 2009, March, which is exactly 6 months ahead of the economy. When did we see commodity start raising? 2009, we see that in June and July, which is 3 months after stocks. And that's why you want to read about this chart. And the fascinating thing is, later on, we're going to talk about, according to this chart, and we're going to tell you where are we right now, so you know where to invest. Oh, and continue going on. So here, right here, this is the thing I was talking about. When the economy is fully in recovery, people are all aware, so they buy stocks. They don't want bond. They don't want fixed income. They want risk. To here, basically everybody is so happy. Everybody is crazy about stock. They want to buy stocks. They don't buy anything else. You talk about fixed income? No, I want to buy stocks. Everybody become too happy? What does that happen for the past experience? We top up. And then we start falling, but during this period, which is a late expansion period, commodity is still rising because, like I said, commodity usually lag stock by about 3 months. So if one day you see commodity are doing so well and everybody around you is so happy about stocks, you gotta be careful because we might be at this stage. And then everything drops, and then we see the economy become recessionary scenario, which is probably not a good idea to invest in anything. So that's a business cycle. Okay, so what I just talked about is really just based on stocks, commodity, and bond, and a little bit about currency, because what currency usually act, let's talk about US dollar, is always the inverse relationship with commodity. So, and that's one big picture we talk about. So let's look at some complementary stuff, which is a very useful and powerful way to confirm what we're seeing here. This thing is called sector rotation. What sector rotation is, if you look at the market, you figure out who's leading the market, what is the best performer, and you're going to figure out and understand where are you now. So let's talk about that. Okay, so let me put, I'll let you guys take a look at the chart later, or I'll maybe post on the Facebook. But I just want to do some explanation about what's going on here. Right here, you see, this is the full recession. The real economy is the green line, and the stock market is the red line. So you can see here, the bottom shows full recession, but the market already bottomed. So between these and here is about half a year, and between here and here, the market peak and the economy peak usually is about half a year as well. So stock market usually leads the economy by half a year. So you can see this chart, and when you're doing the sector rotation, what you're looking is, during this period, who are the market leader in terms of sectors? You're going to see technology, industrial, basic material, and energy. Let me just briefly talk about, well, you guys don't know technology. You guys don't know Apple and Google. And let's talk about something industrial. What is industrial? It's machine. So let's put it this way. If you figure out economy is going to do pretty well, what are you going to do? You're going to start a factory, start producing things. Before you do that, what do? You buy the machine. And this sector is basically, they build and sell machine, industrial. And once you got your factory facility, everything's ready, what do? You buy the basic material to produce the actual things. And that's called basic material. And what do you do later? Well, once you got your factory running, and you have your machine ready, and you buy your commodity, you buy your basic material. Now you have raw material to produce your stuff. What do you want to do now? You want to turn on the energy so you can actually make the production. And that's the energy sector. But there's an interesting thing is, why do we see energy sector leading is a bad thing? Because if everybody's running factory and they do a lot, they drive a lot of cars, they use a lot of gasoline and oil, what's going to happen? We're going to see a very high oil price. And what does that do? It's going to come back and hurt our consumer behavior. You're not going to drive out. You're not going to do stuff because gasoline is the price is too high. So when that happens, what does that lead to? Will lead to the recession of the economy because people stop spending money because the gasoline price is too high. So when that scenario happens, what is that? Who's going to lead the market later? There's something called staples and healthcare and utility. These three sectors are usually defined as defensive sectors. What does that mean? Well, staple is such as stuff like food, Procter & Gamble, those kind of things. You have to use every day, you have to eat. No matter how well the economy is doing, you have to buy food. You have to dry your hair. You have to do any kind of those daily things. That's called a staple. And the healthcare, no matter how the economy goes, right? Economy is bad. If you're sick, what are you going to do? You're going to the hospital. You're going to take medicine. And utility, no matter how the economy do, you're going to turn the heater on, and you're going to, take shower, everything, electricity. And there's one thing also, well, it's not here, it's not a major one, but telecommunication, no matter what you do, you're going to call your friends. You're going to hang out, you're going to talk on the phone. And finance and Semico, these two sectors are interesting because they are usually outperformed with these guys. Because if you build a factory, you produce stuff, what are you going to do if you want to expand your factory? You're going to go to CIBC, borrow loans from them, and they're going to outperform. And so what about if you make a lot of money? Are you going to pay your worker more? Well, usually you will. If you make a lot of money, you're going to raise pay. So the people who work for you got more money to spend, they're going to buy more Starbucks. They're going to eat more McDonald's. They're going to eat more buffalo wings. And they're going to go restaurant. And they're going to go do more shopping. And that's basically what this guy is doing. So as you guys can very clear to see, when the economy is doing well, finance, and I can just call that retail for easy to understand. And technology, you're going to buy iPhone, you're going to buy technology stuff. And the people who hire you is going to produce more stuff. So he's going to use more basic material, and he's going to buy more machine. And then he's going to use more energy. So that's basically the concept. So that's what I'm saying here. The leading and lagging sector will tell us what's going on with the economy. So let me give you one example. If you see basic material and energy is leading, that means we're getting close to the late stage of economy expansion. If you see one day, if you see energy sector and consumer staple or healthcare, these sectors outperform, that means we're here. That's definitely not good. And I'm going to show you guys some real-time example, and you guys will be pretty interesting what you're going to see here. Well, so basically the slide here, I pretty much covered most of the stuff here. So let's just go to example. All right, guys, let's talk about financial crisis in 2008. Okay, let's take a look at, first of all, let's take a look at the sector rotation pattern in 2008. So I'm not going to go over what happened because if you guys read news, you know what's going on. So it take me another half an hour to explain. I don't think that's necessary. So basically, we just want to look at that with the intermarket analysis, and it's showing there's some warning signals. So take a look at that. Consumer and banks are in trouble, but oil sector is the outperformer. Take a look at here. Well, there's gold. Gold has nothing to do with economy. I'll talk about that later. But you can tell oil is the energy sector. Well, by the way, yes, oil is usually the energy sectors. This guy is doing the best. And who are doing, well, the S&P, the broad market is down, and the other guys, especially banks and consumer. But we all know the reason these two are doing pretty bad is because there's housing bubble there. So the cause of problem. And financial are usually the guy who suffer no matter what happens because they do long with any kind of business. So, but from this chart, what we're seeing is energy sector, which is the oil, is outperforming. So what do you guys remember the thing I just said here. I said when we see the energy sector outperforming, there's something not very happy is going to happen later. Let's figure out. So here, well, this is the S&P, the peak happening, it happened in October 2007, but look at these sectors. They top out pretty much, half a year earlier. Meaning these sectors are actually doing a lot worse. And who are they? They're retail and they're housing. I think here, housing. So this means the U.S. problems start from these two sectors. But on the other hand, who are the leaders here? Well, you'll see right here, the market doesn't go up, but the thing is, this thing goes up, that's commodity. And if we break down to see who's the leader here, we all remember oil, back to $140. And Goldman Sachs says, hey guys, I think oil go to $200 because there's no reserve left. So buy oil right now. Well, one thing is when Goldman Sachs and those big investment traders, big time investor, they say something very positive and everybody's happy and you have to be aware. They usually tell you the opposite. Why is that? Well, you have to think this way. If I'm Goldman Sachs, I have a lot of clients and they need to sell things in good price. Who do I sell to? If I sell, everybody's come sell, the price is going to drop. So they're going to lose. So I'm going to write a report and I'm going to say, hey, you know what? I'm Goldman Sachs. I'm so famous. You guys all know I'm like commodity king. I know everything. I have the research team. So what do? My report must be reliable. And that's shared to you guys, the retail investors. You guys will be like, oh my God, that's so good. We read a report from Goldman Sachs telling us buy oil at $140 because it will go to $200. I'm going to make $60. That's great. So on the other hand, this is what Goldman Sachs do. Hey guys, I told a retail investor, so they're going to come in and buy your oil. So what do? You sell to them. So you guys all know the result later. This is the result. When Goldman Sachs wrote the report, it was right here. When Goldman Sachs actually tell people, hey, you know what? Sell oil, never touch oil. It was actually down here. Why is that? Because his client wanted to buy those things. And he has to make you believe. So you'd be like, okay, I'm going to sell all my oil. Because the economy will continue collapsing. It's the end of the world. I'm screwed. Pretty much. There's nothing I can do, so I'm just going to sell everything. So who are the buyers here? Goldman Sachs. And he's buying. And why he keep doing that? Well, he's a Wall Street people, and he make a lot of money from everyone of us. And he still write a report. I'm going to tell you guys what report he just wrote later. Okay, so and we just talk about retail housing. Stocks are actually the laggard, and we just figured out energy was the leader. So we take a look at how defensive stock doing here. Well, we see they're actually outperform the market here. That's the scary thing, because we just realized energy is leading, and now who else is leading? Defensive is leading. So go back to the chart here. Guys, what's going on is here. We're here. That was in early 2008. The stock market is right here already. The economy looks okay. But what's going on later? We see the crash, 2008. So that's basically the big signal you have to watch here. Rising commodity combined with the financial crisis caused the 2008 recession. Take a look at that. Here is the market top. Here's the commodity top. And look at this. When does this happen? This happened around October, November. And when did this happen? May or June. Guess what? It was 7 months later. It was very, very close to 6 months past experience. Unfortunately, this